Anchoring bias is a cognitive bias where individuals depend too heavily on an initial piece of information. This initial information acts as an anchor in the decision-making process. The reliance on the anchor persists even when new, contradictory evidence is presented. Anchoring bias can distort judgment and lead to suboptimal choices. Price anchoring is a cognitive bias where traders rely heavily on initial price points. These price points, such as entry price or historical levels, become reference points. Traders use these anchors to evaluate subsequent market movements and make decisions. This can lead to irrational decisions if the anchors are irrelevant to current market conditions. Price anchoring is a cognitive bias where traders fixate on the initial purchase price of an asset. This initial price acts as an anchor, influencing subsequent trading decisions. Traders may irrationally hold on to losing positions, hoping the price returns to their entry point. Conversely, they might prematurely sell winning positions, fearing a price decline back to the anchor. Price anchoring occurs when individuals fixate on previous price points to assess current value. Historical highs or lows often serve as these reference points, influencing perception. This fixation can distort the true valuation of an asset or product. For example, a stock might seem like a bargain simply because it's below its historical high. This perception neglects the current fundamental factors that determine the stock's actual worth. Therefore, relying solely on historical prices can lead to flawed investment decisions. Price anchoring is a cognitive bias that affects how individuals perceive value. Round numbers, such as $50 or $100, often serve as psychological anchors. These anchors can influence buying and selling decisions, even if arbitrary. This influence occurs regardless of any fundamental justification for the specific price level. Consumers tend to evaluate prices relative to these initial anchor points. This can lead to perceived value or inflated expectations based on round number biases. Information anchoring occurs when traders excessively rely on initial data, such as analyst price targets. This over-reliance can hinder adaptation to new information or evolving market dynamics. Failure to adjust strategies based on current conditions may lead to missed opportunities. Inflexible adherence to initial anchors can also result in inadequate risk management. Anchoring bias can occur when traders fixate on consensus earnings estimates. This fixation can lead to overlooking crucial shifts in a company's underlying financial health. Emerging market trends may also be missed due to this cognitive bias. Consequently, traders may react slowly to significant market signals, impacting investment decisions. Dramatic news headlines can act as strong anchors in financial markets. These anchors significantly influence traders' initial perceptions of market conditions. Sensationalized headlines can lead to emotional and impulsive decision-making. Traders may react based on the headline's emotional impact rather than objective analysis. This can result in trading decisions that are not well-reasoned or strategically sound. Mental accounting describes the human tendency to categorize and treat money differently based on subjective criteria. These criteria often include the money's source or its intended use. This categorization can lead to irrational financial decisions and behaviors. One example is being more careless with profits, often termed house money. This contrasts with the greater care typically given to initial capital or savings. The hold and hope strategy involves refusing to sell a losing investment. This reluctance is often rooted in anchoring bias, specifically to the initial purchase price. Traders rationalize holding with the expectation of the asset returning to the original price. The intention is to sell only when the price recovers to the initial investment level. However, the asset's value may continue to decline, leading to even greater financial losses. This strategy can be a detrimental approach to managing investments. A breakout occurs when the price moves above a defined resistance level. Traders may incorrectly anchor to the old resistance level after a breakout. This anchoring leads to waiting for a pullback to the old resistance, now expected as support. If the pullback doesn't occur, traders miss the move, losing potential profit. Mean reversion assumes prices will always return to their historical average. This strategy can be flawed if fundamental changes justify a new valuation range. Ignoring these fundamental shifts can lead to incorrect market predictions. Traders may miss opportunities in markets exhibiting strong trends. Relying solely on mean reversion neglects evolving market dynamics. A comprehensive analysis should incorporate both historical data and current market conditions. Selective perception is a psychological mechanism influencing information processing. It involves actively seeking information that confirms pre-existing beliefs or anchors. This confirmation bias reinforces the initial viewpoint, potentially skewing one's understanding. In market analysis, selective perception can lead to a distorted view of actual market conditions. Anchoring bias and confirmation bias frequently interact in decision-making processes. Anchoring provides an initial reference point that influences subsequent judgments. Confirmation bias leads individuals to selectively seek information confirming the anchor. Contradictory evidence that challenges the anchor is often ignored or downplayed. This combination reinforces the initial bias, potentially leading to skewed perceptions. The dot-com bubble provides a real-world example of anchoring bias in investment decisions. Investors often anchored to initial high valuations of internet-based companies. This anchoring led to continued stock purchases despite lacking profitability. A common rationale was that the stock was significantly down from its peak. This reasoning disregarded fundamental financial health and business viability. The focus remained on the perceived discount rather than intrinsic value. Bitcoin reached a peak of $20,000 during the 2017 to 2018 period. This peak served as a psychological anchor for many investors. Many potential buyers waited for Bitcoin to return to this $20,000 level before investing. This waiting strategy caused them to miss the subsequent rally in 2020 to 2021. The missed rally represents a lost opportunity for potential gains. Anchoring bias can significantly impact investment decisions and market participation. A value trap occurs when a stock appears undervalued based on historical data. Investors may be lured by a significant price drop from a previous high. However, this undervaluation can be misleading if the underlying business is structurally declining. Ignoring fundamental weaknesses can lead to investment in companies with limited recovery prospects. Thorough analysis beyond simple price comparisons is crucial to avoid value traps. Systematic rules in trading involve predetermined stop losses and take profits. These levels are based on price action analysis, not the initial purchase price. This approach helps eliminate emotional biases from trading decisions. By removing emotional anchors, traders can execute strategies more objectively. Anchoring bias can negatively affect portfolio management. Regular portfolio reviews are crucial for mitigating this bias. Evaluate each position as if you were considering buying it today. This approach helps identify and eliminate positions based on current value, not past attachment. Employing diverse valuation methods is crucial for comprehensive assessment. This approach extends beyond relying solely on price-to-earnings (PE) ratios. Considering varied timeframes offers a more nuanced understanding of value. Analyzing different scenarios aids in stress-testing valuation assumptions. A broader perspective diminishes the influence of any single anchoring bias. This multifaceted approach leads to more robust and reliable valuations. Anchoring bias can negatively impact trading decisions. One mitigation strategy is maintaining a detailed trading journal. Document the reasoning behind each trade made. Thorough documentation includes entry and exit strategies. Regularly review past trading decisions and their outcomes. This review process helps identify patterns of anchoring bias and improve future decision-making. Mitigation strategies can involve mental exercises to counteract cognitive biases. One exercise involves imagining a fresh start with available resources, actively seeking disconfirming evidence, challenges pre-existing viewpoints. This approach reduces over-reliance on initial cognitive anchors. Institutional trading employs systematic decision processes to mitigate biases. Benchmark relative analysis provides a comparative framework for evaluating investment performance. Scenario analysis assesses potential outcomes under various market conditions. Checklists ensure adherence to established protocols, minimizing emotional influence and anchoring bias. Algorithmic trading employs quantitative techniques to enhance objectivity. It minimizes emotional biases that can negatively impact trading decisions. Backtesting is used to validate strategies across diverse historical data. This ensures strategies are robust and not limited to specific market conditions. Reference points in financial modeling are not inherently detrimental. Flexibility is crucial when utilizing anchors in financial analysis. Anchors should serve as references, not as inflexible constraints. Long-term valuation models and historical volatility data offer discipline and aid in position sizing, but should not be treated as rigid rules.